You're listening to Indications by the Conference Board.
Welcome to the Conference Board's Indications podcast. Indications is a public podcast featuring our global roster of thought leaders. Topics range from economic growth and competitiveness to human capital, governance, sustainability, and beyond. Each episode is a serious conversation grounded in data and insights that will keep you ahead of the curve in a turbulent world. I am here with my colleague, Lynn Franco, Senior Director of Economic Indicators and Surveys at the Conference Board. Welcome, Lynn. It's always great to speak with you.
Good to be back, Dana.
Excellent. So let's discuss the most recent consumer confidence survey. Consumer confidence dipped for a third consecutive month. What were the key drivers of the July decline?
Well, we saw a decline in the present situation index that went from 147.2 to 141.3, and a very slight downward tick in the expectations index that went from 65.8 to 65.3.
Well, it seems like the present situation did tick down and there was little change in expectations. Please tell us more about these movements.
Well, what we're seeing in terms of the present situation is a little bit of downward movement now. So I think that sort of bears watching as the summer progresses. And what we saw was that there was a softening in how consumers rated current business conditions. So they weren't as favorable as they were last month. And we saw a little bit of softening in the labor market assessment as well. That still remains relatively strong. And we know that job growth has really been a key pillar of support for consumer confidence. But as we've seen in the claims data, there's been some softening there. And I think we're beginning to see it in the confidence data as well.
It seems like with the present situation data that consumers are still relatively okay. Jobless claims have been ticking up a little bit, but they're still pretty low. We saw pretty strong job additions back in June, and most people are working. They're seeing their wages rise. So is that a fair assessment?
Yes. And I think, the fact that it's still so strong is also translating into some consumer spending. What's probably more of a red flag is consumers' expectations for the short term. And those remain relatively weak and have been for several months, below sort of that 80 mark that generally tends to foretell or predict a recession.
So consumers are telling us that there's a recession around the corner?
There's the feeling that there may be a recession around the corner. And in fact, we did ask a special question on the likelihood of a U.S. economic recession over the next 12 months. And what we found is that about 31% thought it was very likely, close to 22% thought we're already in one, and only 7% of consumers thought that it was very unlikely that we would have a recession over the next 12 months. So I think there is some sense of an impending recession on the horizon.
So what do you think, or what are consumers saying that's driving this perception?
Well, inflation remains a very big concern amongst consumers. So do interest rate hikes. So those have been at the forefront of the concerns list for several months, in fact. And now I think we're also beginning to see even a little bit sort of more rapid softening in purchasing intentions, especially big ticket items, which are very sensitive to interest rate hikes. And so this month, we're seeing a decline in the percent of consumers who said they intend to purchase an auto over the next 6 months, who intend to purchase a home over the next 6 months. And obviously, if they're not buying homes, we also see a decline in major appliances. So there's some, softening in these durable items as well that probably goes beyond just the shift that we've seen coming out of the pandemic from durables to services.
Well, what are consumers saying about services from our special questions?
Well, we did see that, that shift is in place. So, whether it's going to dine out, that seems to be at the top of the list, as well as entertainment, whether it's, movies or the theater. So there is sort of a shift from durable purchases, because obviously how many refrigerators can one buy over a short time horizon, to sort of more of the discretionary services sector.
Well, it seems like this downshift in sentiment and then somewhat in spending is consistent with our outlook. We did have a pretty low expectation for growth in the second quarter, and then also we anticipate slowing growth, maybe even a mild recession towards the end of this year. But what about the other notable thing, which is inflation in the report? The one-year inflation expectations gauge did tick down a little bit, but it remains near all-time highs. What's driving inflation expectations?
Well, yes, it remains elevated despite the slight decline. So it'll be interesting to see if we continue along this downward trend or if we pick up next month. And it's really being driven by increasing food prices and gas prices. Now, I can speak to my own experience. I know that the price has been ticking down quite significantly at the gas pump, which is good news, but still somewhat elevated compared to where we were a year ago.
So how are consumers generally handling rising interest rates and higher inflation?
Well, we're seeing consumers sort of, taking to the sidelines. So, in terms of big ticket item purchases, they're hesitant at the moment, not willing to take on that additional debt, especially since it's more costly given interest rate hikes. And I think the next thing to watch out for is if we continue to see a softening in confidence and increasing inflation and interest rate hikes, is that going to spill over then to sort of some of the other discretionary items, such as, dining out or taking a vacation or going to the movies? So that'll be interesting to see what happens over the course of the next several months.
Thanks, Lynn. Did you notice any regional or income-based differences in consumer confidence?
Well, I think what's interesting here too is that we're seeing sort of the tale of two consumers. So that consumers, the less affluent, let's say those making under $50,000 per year, their confidence is much lower than the more affluent consumers. And these are consumers that are probably feeling the impact of rising prices much more so than the affluent consumers. And it's going to impact their spending more so as well. So it'll be interesting too to see sort of if the implications that we're seeing, at least at the lower end of the income scale, begin to trickle up the income scale, in which case then we could get further pullbacks in consumer spending.
So with all this doom and gloom, what do you think will be important drivers to keep consumers optimistic going forward?
I think jobs remain a key to consumer confidence. They're the major source of income for most consumers. So I think if we begin to see further softening or an erosion in the labor market, if we begin to see an increase in claims or an increase in layoffs, that could potentially have a negative impact on consumer confidence and on consumer spending as well.
Well, thank you, Lynn, as always, for such great insights. It's always great speaking with you.
Great speaking with you, Dana.
This has been Indications from the Conference Board. If you enjoyed this podcast, you may listen to additional The Conference Board offerings wherever you listen to podcasts. Thanks again for tuning in.
This has been Indications from the Conference Board.